There are three types of mutual fund: equity, debt, and hybrid. In this video, we are going to learn types of equity mutual fund. Large cap funds typically invest a minimum of 80% of their total assets in equity shares of large cap companies. These schemes are considered to be more stable than the mid cap or large cap funds. Top 100 stocks by market capitalization are large cap stocks. These companies are categorized by large size, market leadership in their respective industry sectors, greater financial strength, and wide public ownership. Large cap stocks are perceived by investors to be less risky and therefore command higher valuations. Mid cap funds usually invest around 65% of their total assets in equity shares of mid cap companies. These schemes tend to offer better returns than the large cap schemes. These companies are generally younger and smaller in the size compared to large cap companies. Mid cap stocks are perceived to be more risky than large cap stocks and therefore trade at lower valuations compared to large cap stocks. However, mid cap stocks have higher earnings growth potential than large cap stocks. Mid cap stocks in future can become large cap stocks. Mid cap stocks have the potential of giving higher returns than large cap stocks in the long term, but they tend to be more volatile than large cap stock in short term. Small cap funds invest around 65% of their total assets in equity shares of small cap companies. More than 95% of all companies in India fall into this category. These schemes tend to offer greater returns than the large cap and mid cap. Small cap stocks are perceived to be more risky than large cap and mid cap stocks, but they have higher returns potential. Small cap stocks can be extremely volatile in the short term. According to SEBI, these funds should invest at least 80% of their assets in a particular sector or theme. Here, we should understand the difference between sector and theme. Sector funds invest in one industry sector, example in banking, technology, or pharma, FMCG, infrastructure. An investment theme, on the other hand, can encompass several sectors. Healthcare theme can cover several sectors in addition to pharma, like hospitals, diagnostic center, wellness products, health insurance, etc. Thematic funds are more diversified than sector funds. Here, it is important to note that sector or theme based funds carry a higher risk since they focus on specific sector or theme. Equity linked savings scheme is the only equity scheme which offers tax benefits of up to Rs 1.5 lakh under Section 80C of Income Tax Act. ELSS are diversified equity funds with a lock-in period of 3 years. That is, you will not be able to redeem units of these schemes for 3 years from the date of investment. If you are investing in ELSS through systematic investment plan, then each SIP installment will be locked in for 3 years. ELSS have the potential to give superior returns in the long term compared to other 80C schemes like Public Provident Fund, National Savings Certificates, Tax Saver Bank FDs, life insurance policies, etc. However, since ELSS are market linked, they carry higher risk than traditional instruments. These schemes invest in high dividend yield stocks. Dividend means a sum of money paid regularly by a company to its shareholders out of its profits or reserve. Dividend yield of a stock is the ratio of dividend paid by the stock to its current market price. High dividend yield stocks are usually mature companies with stable business models and cash flows. Hence, they are thought to be less risky. Value funds practice value investing strategy. The funds invest in companies which are trading at a discount to its intrinsic value. Fund managers estimate the intrinsic value of a stock after in-depth analysis of the company. It seeks to invest in stocks that are deemed to be undervalued in price based on fundamental analysis. As per SEBI, focused funds can invest in maximum of 30 stocks. Since the number of stocks in this fund is limited to 30, they have higher risk than more diversified equity funds. If the fund manager gets his stock selection right, then these funds have the potential of delivering superior return on investment. Contra equity fund follows a contrarian strategy of investing. These schemes analyze the market to find underperforming stocks and purchase them at low prices under the assumption that these stocks will recover in long term. Contra fund and value fund may sound similar, but there is a difference in these funds. Value funds invest in undervalued stocks, while contra funds invest in underperforming stocks that may be currently giving negative returns. In a multi-cap fund, you will find investments in large cap, mid cap, and small cap companies. In other words, multi-cap funds are diversified equity funds that invest in stocks of companies with different market capitalizations. The investments are done in varying proportions to meet the investment objectives of the fund. FlexiCap funds are similar to multi-cap funds, except FlexiCap fund can dial down their exposure to mid-cap or small-cap right to zero if the fund manager deems it necessary. However, in the case of multi-cap funds, this exposure can never go below 25% for multi-cap and small-cap stocks.